So appreciate y'all for joining us today. Today we're going to be covering life insurance, where we're going to tell you what it is, what it's for, what it is not, as well as how to choose the correct insurance. For those of you joining us for the first time, Alphanso is a flat fee wealth advisory platform, and making sure your insurance plans are optimal is a really important piece of our comprehensive advisory. My name is Mike O'Connor. I'm part of the growth team here at Alphanso. I've been in tech and working at startups for just over 5 years now, from bootstrapped small teams to Series C and beyond. Feel free throughout the presentation to put any questions you have, and we'll be doing a Q&A at the end to answer those questions for you. Our speaker today is Brian Kirby. He is a senior financial advisor at Alphanso. He has over 20 years of experience in advisory and estate planning. He actually began his career as a retail advisor at Merrill Lynch. After a few years, he moved to the institutional side where he worked on mega corporate plans. He was one of the servicing managers on the Apple plan, as well as government 457 plans, 403B nonprofit plans. On top of that, he has extensive experience in executive benefit and liability planning focused around complex estate modeling. So without further ado, I will pass it over to Brian.
Thanks, Mike, and welcome everyone. Thank you for joining us. So today's presentation, we're going to focus on the riveting topic of life insurance planning, and more specifically, how to determine the right amount of coverage for the right period of time at most efficient costs. We decided to address this topic because we've been receiving more and more questions from our clients about how to properly structure a life insurance plan. Our goal is simple: provide the appropriate level of protection while being as efficient as possible with cost and coverage. One of the most common approaches we see is what I would call the one policy approach. The process is relatively straightforward. It's determine a coverage amount, select one policy duration, and purchase that policy. The problem is that this approach often treats today's financial needs as though they will remain constant for the next 20 to 25 years. But as we all know, they will not. Your financial obligations change over time. As you work, you pay down your mortgage, you pay down your student loans, and other debts are eventually eliminated. You fund your children's education, you build your retirement accounts, and eventually you reach a point where your need for income replacement declines substantially. So if your financial needs are changing, why should your life insurance coverage remain the exact same throughout the entire period? This leads us to the approach we most commonly use, which is called life insurance laddering. Rather than purchasing one large policy for an entire period, we separate the coverage into different policies with different durations. For example, if a client needs 3 million in protection today, that does not necessarily mean they need 3 million for the next 25 years. They may need 3 million today, 2 million in 10 years, and then 1 million in 20 years from now. Our objective is to match the insurance coverage to the financial obligation it is designed to protect. By structuring coverage this way, we can potentially reduce the lifetime out-of-pocket costs of insurance while maintaining the appropriate level of protection throughout the family's higher risk years. Let's take a look at an example. Now, this is a real world example. This is a client we just recently did an evaluation. We have a married couple with 2 children, ages 3 and 5. They have a $750,000 mortgage with 25 years remaining. Both spouses work in tech. The husband earns approximately $200,000 before taxes, and the wife earns approximately $150,000 pre-tax. They also have remaining student loans, credit card debt, auto loans. Now, their goal is to retire at age 60, at which point they expect the mortgage will be paid off and their retirement assets will be fully established. To begin the analysis, we use a framework commonly referred to as the DIME method. So that's going to be debt plus income plus mortgage plus education fund. The dime method is useful because it gives us a starting point for determining the amount of coverage that a family might need. But there's one important limitation. It tells us how much coverage may be needed today, but it doesn't necessarily tell us how long that coverage will be needed. Okay. So let's apply the analysis to our example. Right. For the husband, the initial calculation produces a coverage need of approximately 2.815 million. For the wife, the calculation produces approximately 2.4 million. Now, these figures incorporate income replacement, the mortgage, other debts, education funding, final expense, and an emergency family reserve fund. So at this point, we've established the amount of protection we've needed. Now we need to answer the second question. How long does each dollar of that protection need to remain in place? So the one policy approach, okay, is going to take that need. So if we were to take the husband's total need and purchase the entire amount through retirement, we would be looking at a 25-year policy with an annual premium of approximately $2,820, or a total approximate lifetime cost over the 25 years of the policy of $70,465. Now, for the wife, the annual premium would be approximately $1,856, with a total premium cost over the lifetime of about $46,400. That's going to be over the 25-year period. This approach certainly provides the protection, but there's another question we should ask. Are we paying for more coverage for longer than we actually need? So what we utilize is what I call the advisor approach, or laddering. Okay. Now let's look at the same family using the laddering approach. Today, the family has approximately a 2.8 million and a 2.4 million of calculated needs. But let's think about what happens over the next 15 to 25 years. In 15 years, the children's education funding should be substantially addressed. The family would have had 15 additional years to build retirement assets, pay down the mortgage, and eliminate other debts. Therefore, their financial obligations should be significantly lower. So instead of treating the entire coverage need as one block, we compartmentalize the coverage into different time periods. For the husband, the structure would look like this: 1 million for 15 years, 1 million for 25 years, and then the remaining 815,000 for 25 years. So this allows the coverage to decrease as the family's financial obligations decrease. And that produces a materially different cost structure. So in 15 years, that first policy premium will drop off. In 20 years, the second policy premium will drop off. And he's only paying for that final for 25 years. So in real dollar terms, the annual premium falls to approximately 2,270,000 as opposed to the one big policy, with total premiums of approximately $47,595. That represents an illustrated lifetime savings of approximately $22,870 compared to the single policy approach. Now, if you apply the same concept to the wife, her ladder produces an annual premium of approximately $1,667, with an illustrated lifetime savings of approximately $13,505. Okay, so combined, that's approximately $36,375 of illustrated premium savings, while still providing coverage designed around the family's changing financial needs. The fundamental concept behind the advisor approach, we're not necessarily reducing the protection the family needs today. We are reducing the amount of coverage they pay for after they no longer need it. Okay, so that's a big savings. I mean, we're looking at $36,000 over a lifetime. That's, take a trip to Europe and send me a postcard. So the next topic I want to talk about is something that comes up all the time. So this is life insurance as an investment. Okay. Can life insurance be used as an investment? This is where we need to be particularly careful about separating the purpose of insurance and the purpose of investment. So here is an actual example from a client they sent us to look at and evaluate. They had an agent that recommended an index universal life, or what's called an IUL policy. Okay. So the plan's out-of-pocket cost for this was 50,000, 50,000 a year. It was listed as a 6-pay. So they're paying 50 grand a year for 6 years with a total out-of-pocket cost of around $300,000. Now, in the illustration they showed us, at the end of the 30-year period, so they pay 300,000 in at the end of 30,000 at the end of 30 years, the accumulated cash value is 1.178 million. Okay. Now, an IUL can have cash value accumulation. It's tied in part to the performance of a market index. Now, this is subject to the policy's specific crediting methodology, caps, floors, fees, and other contractual provisions. Now, in this particular illustration, the policy had a 2% floor and an 8% cap. In simple terms, under the illustration crediting method, the crediting interest would not be below 2% or above 8% in a given period, subject to the policy terms. The client was planning on contributing approximately 50,000 per year for 6 years. Now, the initial death benefit on that was $1 million. So over the 6 years, the plan premium was around $300,000. And according to the projected cash value, it was 1.178 million after 30 years. Now, let's compare that with another way of approaching the same financial objective. Okay. Instead of using the IUL as a primary vehicle, we can first determine the actual insurance need. Now, in this example, the client needs more than 1 million of life insurance. So the 1 million in IUL does not fully address the insurance need. He would have to buy an additional 1 million in coverage. He would do that via term, usually. Okay. Now, we could instead purchase the appropriate amount of term insurance, take the difference that he would have put into that IUL, and invest that in the market. Okay, so using our figures and our illustration, the total investment over 6 years minus the term premiums would come to approximately $290,000. Okay, if the difference were invested and earned a hypothetical 5% annual rate of return, the account value after 30 years would be approximately 1.5 million, 1.493. That's approximately 315,000 more than the illustrated cash value. And importantly, the investment would be generally liquid, separately owned, rather than being part of an insurance policy's cash value structure. Now, there's some important caveats here in this comparison. The 5% return is based on a hypothetical conservative assumption. When I'm doing a projection, I always try and use a number that's as conservative as possible. Based on the historical rate of return for the S&P, it would actually be a higher number. Now, the IUL should be evaluated based on the actual policy illustration, guaranteed versus non-guaranteed values, charges, surrender provisions, and other policy-specific terms. The point is that insurance and investing solve different problems, and they should not be mixed. Now, life insurance exists first and foremost to protect family against financial loss. Okay? The most important question isn't what is the most sophisticated policy I could buy? It's what financial risk am I trying to protect against? How large is that risk? And for how long does it exist? Once we answer these questions, we can determine the appropriate amount of coverage, the appropriate durations, and the most efficient structure. That's why I believe life insurance should be incorporated into the broader financial plan, not evaluated in isolation. The goal isn't to buy the most life insurance. The goal is to buy the right amount of insurance for the right amount of time at the right cost. Now, I've been doing this for over 25 years. I have yet to see someone show me an illustration of a permanent life plan utilizing investment that will beat a term plus invest difference. So that's all I have for today. Any questions you have, happy to answer. Um, put those in the chat. Mike, back to you. Do we have any questions so far?
Yes, we have a couple. So I'll start listing those off. If anyone thinks of any as we're going through these, shoot them in the chat. So the first one is, does the laddering mean that they're going to be maintaining three different policies?
That is correct. It's three different policies, but there's no maintaining. You're still just paying um, the you could basically basket into one premium, but they're just divided into three different policies.
Got it. Is laddering also effective for smaller amounts?
Yeah, yeah. I mean, you can break it down. Um, typically, depending on the carrier, typically term policies they won't insure for under 100,000. But I look at probably 65 different carriers, so there's usually always a solution that I can find, regardless of the amount.
Got it. And I think this was back on the scenario with the husband and wife, but they were asking
Oh,
why um, times 10 and the 0.75.
great question. So the standard school of thought, and I use this, is so if you have two people with two kids living in the house, okay, if God forbid something happens, one person is no longer there, you are going to reduce your spending by about 25%. So that's why when I do the evaluation, I calculate 10 times salary and then I multiply that by 0.75 because you're not going to have another car payment. You're not going to have cell phone payments. You're not going to have, there's going to be additional food costs. So what you're looking at as far as a family structure goes and how much you're going to be, your outflow is going to be, it's going to be about 25% less if you have a one less parent living in the house.
Got it. If I have a 25 to 30-year policy, is it too late to update now to a shorter period?
I mean, that's going to be carrier specific. But I wanted to mention anybody who's listening, if you have someone that is proposing a policy for you, my email is going to be on here. Shoot me the policy in the email. I'll take a look at it, break it down, and I'll give you the actual facts of what they're proposing, especially if it's an IUL with high premiums. But depending on the carrier that you have, they may have options for you to reduce duration um, and reduce death benefits. No carrier will allow you to increase your death benefits, or increase your durations because that requires additional underwriting.
Got it. How often does insurance need to be revisited once set up?
I like to do just kind of general policy reviews a year. Also, on any milestones, you have another kid, you're buying a new house, you're buying a vacation house, um, things change. Uh, so you want to review on any milestones, but also you want to just take a look at your policies, pretty much every year to make sure they're still in line with where your debt obligations are, what you've contributed to your retirement, just to make sure you're keeping up.
Nice. Does Alfonso also help with homeowners insurance policies?
We will review. So the way that our platform is designed, we review all types of insurance. So yeah, we will review. Now we don't sell insurance. Okay, so typically how it works now we have clients that we have placed policies for, but typically how it works is someone sends us their insurance needs or whatever they've been proposed, whether that's life, um, accident, homeowners, car insurance, we'll review the policy and we'll look at the marketplace to see if there's a better option for them. But back to that, typically what we'll do is we'll review it, we'll give a recommendation on what we think is best for them, and then they can go into the marketplace and purchase that. Or if they want us to place it, we can do that as
What about the tax benefits for the IUL? Have you accounted for that?
well. Yes, it's I get that question a lot. So when you say tax benefits, okay, so if you surrender money from an IUL, if you do it in a certain period of time, you have a surrender charge on it. Okay, if you surrender funds from an IUL, those are taxable. Anything over and above the basis you pay. Now, if you do what's called the loan provision, where you take a loan from your IUL, okay, so now that loan is credited at, depending on the policy, most of them are at 6% right now. Okay, so what happens if you take too much money out? The policy just falls apart because the way a universal life is structured, you have the cost of insurance and your investment returns. Okay. So every year, your cost of insurance goes up because it's based on your age. Okay. So it's not a fixed cost. The cost of insurance increases. So as that policy ages, your cost of in your insurance ages, and it reduces the rate of return on your investment because the return is getting eaten up by increasing charges. So
Hmm,
from a taxable standpoint, if that's your goal that you want tax-free income, buy the term, invest the difference. We will build an equity portfolio for you. By the time that you want to take money out, you can do asset-backed loans from any brokerage, probably at a better interest rate than the insurance policy is going to charge you. So it's not even close. If tax-free loans are what you're looking for, that is easily solved.
got it. Can life insurance be used as a source of income in retirement, but as a volatility buffer to tap into when the stock market is down and withdrawals from portfolio are to be avoided to let the market recover?
The last question, I answered that exactly the same way. Is you can utilize life insurance proceeds as a supplement to retirement funds, but if that's what you're looking for, if you want more stability, I would build a bond ladder. And if tax free income, I could build out a uni bond ladder. It's going to give you tax free income with the same risk profile. Right now, um, if you're in an index universal life, like in this example, you still have market risk. Right now, there might be a floor of 2%, but if you're only earning that 2% and you start withdrawing money out, that policy will fall apart. So if income replacement income is, I can do that much more effectively through an asset based portfolio.
Got it. Awesome. So that's going to do it for questions. So we'll go ahead and wrap it up here for today. We'll be sending out an email with a link to schedule time with one of our advisors so that you can ask them more specific questions about your situation. But we appreciate everyone's time and thank you for coming.
Anybody who's still here, if you think of any other questions, send me or Mike an email. Happy to help. Bye, everybody.